I'm Al Brooks. Thank you for watching the Brooks Trading course. This is the fifth of 5 videos on swing trading examples. When the daily chart is in a strong bull trend, a buy the close bull trend, and you're a day trader, the odds are today will be another bull day, and therefore, if there's an early sell-off, as a day trader, you should look to buy the reversal up. Likewise, if the daily chart is in a strong bear trend and you're a day trader, you have to assume that an early rally will fail and you should look to sell a reversal down, expecting another bear trend day. When the market's in a microchannel, for example, a bull trend, that means there are no pullbacks. When there finally is a pullback, traders will look to buy. If you're a day trader trading on a 5-minute chart, a 60-minute chart, and the market falls below yesterday's low, and the daily chart is in a bull microchannel, traders will look to buy the reversal up. The opposite is true in a bear microchannel. If you're a day trader, if the daily chart is in a bear microchannel, you'll look to sell an early reversal down from above yesterday's high. When the market's in a trading range on the daily chart, you're going to be thinking just the opposite. If there's a big bull bar near the top, traders will be looking to sell the close, and on the next day, they'll look to sell a reversal down. Also, if there's a big bear bar near the bottom of the trading range on the daily chart, day traders will look to buy a reversal up on the next day. Higher time frame support and resistance are important. If the market is testing support on the daily chart and you're a day trader, you should look to buy a reversal up on a 5-minute chart, a 1-hour chart, a 2-hour chart. Likewise, you should look to sell a reversal down if the market is in a bear trend and now testing resistance. This is the euro versus the dollar, a daily chart, clearly in a bull trend. Very strong bull bars. Once it's clearly in a buy the close bull trend, like by the close of this bar, traders should look to be buying. They either buy the close if they're trading the daily chart, or if they're trading a 5-minute chart or a 60-minute chart, on the next day, they look to buy early. So, for example, if there's a small sell-off on the open, they'll look to buy, looking for a swing up. You can see that even strong bull trend bars have little tails on the bottom, and that means that there was a sell-off early in the day and that the market rallied the remainder of the day. 90% of the time, that tail is caused by an early sell-off. 10% of the time, it can be caused by a late sell-off that reversed up. If you're a day trader and you see an early sell-off, you have to assume it's going to reverse up and the day is going to become a bull trend day. Day traders are going to look to buy reversals up from early sell-offs. For example, this day in green is this day, and if the market on the next day pulls back, traders will look to buy any reversal down. Here's the open of the day. There's the low of the day, the next bar. It's only a couple pips lower. However, that is all that was needed to create a tail on the bottom of this bull day. Traders are going to be looking for an early low of the day, and they're looking to buy for any reason. Here we sold off at the end of yesterday. Traders are going to buy a reversal up today, above a bull bar, above here, or we have a pullback, buy above this bull bar, expecting trend resumption up. This is a 30-minute chart. I wanted to be able to fit the entire day in, so I chose a 30-minute chart. Traders trading the 5-minute chart will be looking to buy a reversal up from a sell-off right here on the open. The bears tried to sell off, and we have a double bottom. Bulls will expect it to fail. The daily chart is in a very strong bull trend. Chances are today is going to be another bull day, and therefore traders expect that any sell-off will fail. You can see here's the open of the day. Even though we sold off, it's simply a test of the open, and we ended up resuming back up. This is the daily chart of the dollar versus the Canadian dollar. clearly in a bear trend. At some point, maybe by the close of this bar, traders conclude it's a sell the close bear trend, that if you simply sell the close, you're going to make money. Even strong bear trend bars in strong bear trends have tails on the top of the bar. 90% of the time, that tail is caused by an early rally that reverses down. If you're a day trader trading on a 5-minute chart, 60-minute chart, you therefore will look to sell a reversal down from an early rally. This day is right here. This is a 30-minute chart. The market opened here, rallied. Traders expect the bear trend to continue, so they're looking to sell rallies, expecting the market to close on or near its low. Another rally, they sold it. Another rally, they sold it. This little rally from the open to the high put a tail on the top of this bar. Very difficult to see, but there is a small tail there. When you're looking to sell, it's usually better to sell below bear bars, especially bear bars that are at the moving average. Sell below this bear bar, get filled here. Sell below this bear bar, get filled here. Sell below this bear bar, get filled here. When the daily chart is in a microchannel, it's in a strong trend. For example, if it's in a bull microchannel, traders will be very eager to buy when it finally pulls back below yesterday's low. Therefore, if you're a day trader and you know the daily chart is in a bull microchannel, you'll look to buy at yesterday's low and below or on a reversal up. If it's in a bear microchannel, you'll look to sell a reversal down from above yesterday's high. Very strong bull trend, the Australian dollar versus the US dollar. And this is a bull microchannel. Every low is at or above the low of the prior bar. Traders, therefore, are looking to buy at the prior low or below, knowing that the first pullback might last a day or two or three, but not long, and the bull trend will resume. Traders are going to be looking to buy reversals up from below yesterday's low. You can enter as a day trade, 5-minute chart, 60-minute chart, and then hold, knowing that the odds are we're going at least a little bit higher and we'll get follow-through buying over the next several days. You have to trade small enough. First, you have to decide where your stop is. Chances are it's not going to pull back more than the height of the average day, and therefore you can put a stop, maybe the height of an average day down, maybe a little bit lower. And you have to trade small enough so that you can use the appropriate stop. This is a 4-hour chart, a 240-minute chart. This is the bull microchannel on the daily chart. After the third or fourth day, traders are looking to buy at every low, and they finally get a chance up here. This day finally pulled back below that low. That's this day pulling back below this low. And then there was a second pullback. This day fell below that low. This day fell below that low. Traders are going to be looking to buy reversals up for a resumption of the bull trend. Always better to buy above bull bars when you have a pullback. This is a daily chart of the US dollar versus the Canadian dollar, and it's the opposite. It's a bear trend. It's a bear microchannel here. Starting at this bar all the way down to this bar, every high is at or below the high of the prior bar. Traders are therefore looking to sell with a limit order at the prior day's high. And if you're a day trader, you're looking for the market to go above yesterday's high, and then you're going to sell a reversal down. Sometimes the pullback will last 2 or 3 days. However, the odds are high that you'll get at least some resumption of the bear trend. You always have to trade small enough to accommodate an appropriate stop. Chances are the pullback is not going to go more than the size of an average day, so you can put a stop about the size of an average day or twice the size of an average day. This is a 30-minute chart showing this bear trend day. And you can see the market went above yesterday's high here and went above it again here. Traders are going to look to sell a reversal down, especially below a bear bar here or here, expecting that the odds are the bear trend is going to resume either this day or within a day or two. Break above yesterday's high, failed. Break above yesterday's high, failed. Second entry short, failed breakout yesterday's high. Now we have a double top today. Break below the neckline, maybe we'll fall for a measured move down. When the market's in a trading range on the daily chart, traders will look to sell reversals down from the top, buy reversals up from the bottom. This is a daily chart of the euro versus the yen. Remember my 80% rule. Markets have inertia. They tend to continue what they've been doing. In a trading range, 80% of the time, if the market tries to break above the top or below the bottom, you're going to get a reversal. So instead of buy the close, it's sell the close when you see strong bull bars near the top. It's buy the close when you see strong bear bars near the bottom. Or you look to buy a reversal up. Strong bear bar near the bottom, you look to buy the close or you buy the reversal up. Or if you're a day trader, trading a 5-minute chart, 60-minute chart, tomorrow, this bull day, you look to buy a reversal up. Similarly, up here, if you're a day trader, you know this bull bar is not going to lead to a bull breakout. Therefore, the next day, you look to sell a reversal down. If you take the sell, you can hold for a test of the middle of the trading range. If you take the buy, you can hold for a test of the middle of the trading range. If you buy at the bottom, you can also hold for a test of the middle of the range. Sometimes it gets there within a day. Sometimes it takes 2 or 3 days. This big bull trend bar is this bar. This is the 60-minute chart. And this is the next day. It became a big bear day. Even though this is a very strong bull trend, it's in a trading range. Traders are expecting strong bull trends to fail, and they'll look to sell a reversal down. If you're a day trader, you look to sell below a bear bar. This is a second failed breakout above yesterday's high. Yesterday's high tried to reverse here, but 4 bull bars and a doji bar. Better to wait for a second sell, especially when you get a decent sell signal bar. The bears who took that sell could make about 100 pips on a day trade, or they could hold for the market to pull back down toward the middle of the range a few days later. This bear bar is this red box here. This is a 60-minute chart. This is the daily chart. Big bear bar closing near the bottom of a trading range. Chances are the bear breakout attempt is going to fail. And if you're a day trader, you're going to look to buy a reversal up. Here we have a 2-bar reversal on the 60-minute chart with a good bull bar closing on its high. That's a reasonable buy for a test back up to the middle of the range. Traders should always be paying attention to higher time frame support or resistance. If you're a day trader and the market's testing daily, weekly, or monthly support, you should be looking to buy a reversal up. If it's testing monthly, daily, weekly resistance, you should look to sell a reversal down. This is a daily chart of the euro versus the dollar, and it's in a pretty strong rally. Strong rally here, strong rally here. Traders will buy pullbacks. This was support here, resistance here, resistance here, resistance here. It's probably going to be support. All of these prior lows and prior highs create an area of resistance when the market's below it and an area of support when the market's above it. Very strong rally here. Chances are traders will look to buy when the market gets down to this support. If you're a day trader, you can be looking at a 5-minute chart, a 60-minute chart, and when the market gets into this support zone, look to buy a reversal up, either for a day trade or for a swing up on the daily chart. Market's pulling back into the support zone. Traders will look to buy either at the market or better on a reversal up. Bears who are short are going to look to take profits there. Bulls are going to look to buy a pullback from this strong rally. Every reversal up on the daily chart begins with a reversal up on every smaller time frame chart, 60-minute chart, 5-minute chart. And if you're a day trader looking at those smaller time frame charts, you can enter early. The market's in a bull trend, strong bull breakout, pulling back to support, look to buy a reversal up. Likewise, if the market is in a bear trend and it's rallying up to resistance, not here, traders will look to sell a reversal down. You can think of it as trading the daily chart and then taking entries on a smaller time frame chart, looking for an earlier entry. This is a 120-minute chart. We sold off here. This is that sell-off, and we're into the support zone. This is the support zone here. Traders should look to buy a reversal up, especially above a bull bar, micro double bottom, a pullback from a reversal up from the micro double bottom, another pullback from a very strong reversal up, buy above a strong bull bar, looking for a resumption of the bull trend. Consecutive sell climaxes. Every bear bar, every series of bear bars is a sell climax. You can call it a parabolic wedge down into the support zone. Chances are bears will take profits and bulls will buy. Always better to buy above a good-looking bull bar closing near its high, especially a second entry buy. Consecutive sell climaxes, parabolic wedge, reversal up from support. Look to buy for a swing up. If you held, the rally continued for another 300 pips up from this low. Here's the opposite. We have a strong sell-off. Therefore, traders should look to sell a rally to resistance. Resistance, the top of the most recent sell climax, the 50-day moving average, and about a 50% pullback of the bear trend. This is a 5-minute chart of this big bear day. You can see that big tail on the top. That was caused by an early strong rally that reversed down from resistance. Bull bar, big bull bar, another big bull bar, consecutive buy climaxes, a buy vacuum test of resistance. This blue line is the 50-day moving average plotted on the 5-minute chart. A trading range late in a bull trend, possible final flag, especially given that we're at several resistance areas on the daily chart. This entire rally might simply be a buy vacuum test of resistance, and the bulls who bought earlier will take profits, and the bears will sell again. Always better to sell below a strong bear bar, especially if there's a decent setup. Final flag, consecutive buy climaxes, parabolic wedge rally to resistance on the daily chart. Huge bear bar, totally reversing the rally. Odds are we're going lower. Traders can sell that close or sell the close of the follow-through bar. When the daily chart is in a strong bull trend, for example, a buy the close bull trend, if you're a day trader, look to buy an early sell-off. If the daily chart is in a strong bear trend, a sell the close bear trend. And if you're a day trader, look to sell an early rally, expecting the bear trend to resume. If the daily chart is in a bull microchannel, traders will look to buy a reversal up from below yesterday's low. A bear microchannel, traders will look to sell a reversal down from above yesterday's high. If the market's in a trading range, traders will look to sell a reversal down after a big bull trend bar near the top. They'll look to buy after a big bear trend bar near the bottom. Day traders will look for entries on 5-minute charts, 60-minute charts. If the daily chart is testing important support or resistance, look to enter on a reversal from the support or resistance. Day traders can take an earlier entry on a smaller time frame. I'm Al Brooks. Thank you for watching the Brooks Trading Course. This is the 5th of 5 videos on swing trading examples.